One fund on point for today, the expert to talk about it. Welcome to the ETF of the Week. Yes, it's the ETF of the Week, where we get the latest take from Tom Lydon. He is the vice chairman at VettaFi, where they have a full suite of tools that's going to help you be a better, smarter, savvier investor in exchange-traded funds. Check it out at VettaFi.com. Tom Lydon, great to chat with you again.
Great to be back. Thanks, Chuck.
Your ETF of the Week is
the BondBloxx US Dollar High Yield Bond Sector Rotation ETF, ticker symbol HYSA.
HYSA, the BondBloxx US Dollar High Yield Bond Sector Rotation ETF. There is a lot in that name. There is a lot in this fund. But high yield now, Tom? Because that's not a call that a lot of people are making. So why this fund this week?
Well, you're right, Chuck. There's a lot packaged just in the name. There's a lot packaged in this ETF. There are actually a lot of people who are surrounded in this ETF that make it all work. So first of all, yes, high yield, sector rotation. BondBloxx is one of those innovative companies that actually have ETFs that are specific to the fixed income space and specific sectors. New and innovative, and they've done really well over a short period of time. They have a sub-advisor to this ETF, Macquarie, world-renowned fixed income manager who actually comes in and uses the tools, those sector bond ETFs, to determine the allocation within this ETF. So imagine the different sectors in the ETF space specific to the high yield marketplace. Macquarie comes in based on their analytics to determine how much, if any, of each of those sectors would be in this allocation. Pretty innovative because, as you can imagine, during certain economic periods, some sectors tend to do better than others. And as you're warning, Chuck, high yield now, especially as we've seen these hikes in interest rates, why would we even think about it? Yeah, I mean, this is below its trend line for sure. However, there's a lot of people out there in the marketplace that are feeling we may see lower interest rates a year from now. And if that's in fact the case, not only can you lock in these higher yields, but you may be able to realize some appreciation along the way. Remember, if rates go lower, the value of the bonds that are currently outstanding go up in value. Hence, high yield, greater yields, and if you're picking the right sector at the right time, based on the current economic environment, you could actually do well also. So just today, Chuck, I talked to Paul Matlack, who's one of the portfolio managers over at Macquarie, along with Joanne Bianco, who's one of the partners at BondBloxx. We're actually doing a webcast coming up specifically about this strategy. And when you look at the yield, this ETF currently has a yield to maturity of 9.24%. So if we're actually towards the tail end of hikes and we might see lower rates a year from now, it's pretty nice to be able to look at what those rates might offer, also with the ability for maturity. And if these companies are doing the right job to stay with the companies that, especially in the high yield side, are positive, healthy, financially they're paying off their debt, very little defaults, that could really do well in the future.
So frequently when we're talking about certain asset classes, I will ask, how much of a portfolio do you want to make it? And I'm always asking you, is it a 200-day moving average play? Well, let's put those two things together, because obviously high yield or junk bonds, an acquired taste for some people. So how much of a portfolio would you let it be? And then the secondary side, obviously not a trend following play, or if it is, you're not getting it now. But when you are making an allocation, even if you're not a trend follower, because you always will say, well, hey, it's a moving average play if you're a trend follower. But if you're not, and you know that here's a fund that is below its trend, would you say, okay, I might go to 5% or 10% of a portfolio in high yield or junk if it's above trend, but I'll be at, half that allocation if it's below. Does trend ever affect the person who is not a trend follower?
So there's a lot packaged into your question, Chuck, and I'll just say this from a holistic standpoint. In the last couple of years, if you were a fixed income investor, you probably took some money off the table. You probably pushed some into cash or short duration treasuries. And if you did so, you did the right thing. Fast forward to today, where there are a lot of people that have cash on the sidelines and feel that rates might be lower a year from now, don't want to be stuck on the sidelines and penalized if in fact we see lower rates in the future. So with that in mind, this really doesn't have as much to do about trends, because if this ETF did have 200 days in history, it would be probably below its trend line. But more importantly, as people are gradually going to move back to a 60-40 allocation, we have an opportunity to look past major market indices like the Barclays Ag. We can go into sectors, we can go into active management, we can go a little bit more into specific high yield versus corporate credit. And with those choices in mind, we think about the current yields that are available today that we haven't seen in 20 years. I mean, they're very, very attractive. The thing that's scary for most people is a lot of people lost money in bonds the last couple of years, but we're probably to the tail end of that risk cycle. The folks at Macquarie point out that if you invested after a rate hike period and the Fed had two pauses, usually the next 6 to 12 months is fairly favorable. So if that at all is the case, even if things were flat from here and you got that 9% coupon, it's pretty attractive. I think the biggest thing I'm trying to point out here for those folks that felt really good about moving money to the sidelines and now you're in money market funds getting 5%, that's great. But if rates are lower a year from now, that 5% isn't going to be available and you probably missed out on some appreciation.
And in terms of where the money comes from, are you taking this money from the money that's on the sideline, or are you taking this out of your bond allocation?
I would say you're probably taking it from money that's on the sidelines, because there are a lot of folks that were burned a bit from the bond market, and rightly so. But again, as we look forward, I think there are going to be rosy periods. I mean, we haven't seen these yields in a long period of time. But in order to actually experience these yields, you have to actually invest in the bond market. And then to get close to 8, 9, 10%, you've got to be in the high yield market. And rather than just buying cap-weighted market indices and fixed income, why not look to experts who not only have different sector weightings, but will select the proper weightings based on the current economic periods. The important thing here, folks, is go and do your homework. Both at Macquarie and at BondBloxx, understand what's underneath the hood.
It's HYSA, the BondBloxx US dollar high yield bond sector rotation ETF. The ETF of the week from Tom Lydon. Tom, great stuff as always. See you next week.
Thanks, Chuck.
The ETF of the week is a joint production of VettaFi and Moneylife with Chuck Jaffe. Yep, that's me. If you want to learn about my hour-long weekday program, go to MoneyLifeShow.com or look for it wherever you find your favorite podcasts. But if you want to learn more about investing in exchange-traded funds and get a suite of tools that's going to help you do just that, make sure you check out VettaFi.com. They're on Twitter at Vetta_Fi, and Tom Lydon, their chairman, my guest, well, he's on Twitter too. He is at Tom Lydon. The ETF of the week is here for you every Thursday, and we'd love it if you made sure that you didn't miss an episode by following along on your favorite podcast app. Until next week, happy investing, everybody.